Current live trading data places Bitfarms stock, ticker symbol BITF, exchanging hands at approximately $2.66 USD per share, showing a volatile intraday push of roughly 2.3% to the upside amidst a broader sector struggle. If you are watching the charts right now, you are seeing a battleground. The stock is oscillating tightly, refusing to break out significantly despite Bitcoin hovering near the $84,000 mark. This price action creates an immediate psychological disconnect for the average investor who logs into their Fidelity mobile app, expecting to see a direct correlation between the asset and the underlying cryptocurrency. The expectation is linear. Bitcoin goes up, Bitfarms should fly. The reality, however, is far more abrasive and complex. What you are witnessing is not a failure of correlation, but a fundamental repricing of the company from a pure-play miner into a heavy infrastructure asset, a transition that is burning cash in the short term to secure survival in the long term. The market is currently punishing this capital expenditure, creating a massive disparity between the company's book value of power assets and its market capitalization. Most people analyzing this stock through the lens of a standard interactive broker's trading platform are missing the forest for the trees. They see the earnings miss from November 13th, a net loss of $46 million for the third quarter of 2025, and they immediately hit the sell button. They see the hash rate figures and think the growth is stalling. But if you dig beneath the headline numbers, you find a narrative that isn't about Bitcoin mining at all anymore. It is about the scarcity of power access in North America. The expectation is that Bitfarms is a crypto stock. The reality is that Bitfarms has effectively become a power generation and grid management firm that uses Bitcoin mining as a load balancing tool, while it pivots aggressively toward high-performance computing and AI. This is why the stock isn't mooning with Bitcoin's recent tap of $84,000. The smart money, the institutional flow you don't see on your Robinhood app, is waiting to see if the management team can actually execute the physical upgrade of their facilities without diluting shareholders into oblivion. Let's pause and look at the recent volatility that has defined this ticker. Just days ago, the stock was hammered, dropping significantly following that Q3 earnings report where revenue came in at $69 million. On the surface, that number looks decent, but the market fixated on the operational loss. When you engage in online investing, particularly in this sector, you have to understand that loss is often a synonym for expansion in the mining game. Bitfarms is currently digesting its massive acquisition of Stronghold Digital Mining, a deal that closed back in March 2025. This wasn't just a merger, it was a land grab for power capacity in Pennsylvania within the PJM interconnection grid. Why does that matter? Because the PJM grid is the most coveted power market in the United States for AI data centers. By acquiring Stronghold, Bitfarms didn't just get more Bitcoin miners. They got access to over 300 megawatts of power capacity that can be converted to run NVIDIA H100s or GB200s. The market, however, is impatient. It sees the debt assumed and the integration costs, and it sells. This creates the tension we are seeing on the chart today. Retail investors are scared by the red ink, while long-term infrastructure funds are likely accumulating quietly at these depressed levels. If you are managing your own funds, perhaps using a Schwab Intelligent Portfolio setup or just trading actively on SoFi Active Investing, you need to recognize the poison pill context that still lingers over this stock. Remember the hostility from Riot Platforms in late 2024? That saga effectively ended with a settlement, but it changed the DNA of Bitfarms. The board was reconstituted, the governance changed, and the company was forced to grow up fast. They are no longer just a Canadian miner, comfortable with their hydro assets in Quebec. They are now an aggressive U.S. player. This shift is expensive. The Pennsylvania expansion and the upgrade of the Yuma facility are draining cash. The stock is currently trading at a level that implies the market has zero faith in their AI pivot. If they succeed in converting just a fraction of their gigawatt-plus pipeline to HPC, the stock is drastically undervalued. If they fail and remain solely dependent on the block reward, which has been halved and is now ruthlessly competitive, then the current price might actually be fair value. This is the binary risk you take when you buy BITF today. There is also the macro factor pressing down on the price. As we see Bitcoin slide below 99K and settle in this $84,000 range, the liquidity crunch is hammering risk assets. The Federal Reserve's hesitation to cut rates aggressively in late 2025 has kept the cost of capital high. For a company like Bitfarms, which needs to borrow money or issue shares to build data centers, high interest rates are a boot on the neck. When you read reports on Fidelity wealth management portals, they often cite cost of capital as a headwind. This is exactly what they mean. Bitfarms has to pay more to grow, which eats into the margins that investors are desperate to see. The recent slide in the stock price reflects this liquidity fear. Investors are looking at the treasury yields and thinking, why risk it on a minor transition play? This sentiment is why the stock is struggling to hold the $3 level despite the underlying asset, Bitcoin, being historically strong. Let's break down the operational reality. Bitfarms is currently operating with a hash rate efficiency that is improving, targeting that sub-20 joules per terahash efficiency level. In plain English, they are using less electricity to mine the same amount of Bitcoin. This is critical because the halving event of 2024 is still being felt. The weak miners have died off or been acquired. Bitfarms survived because of its low-cost power base in Paraguay and Canada. However, the future isn't in low-cost power for mining, it is in reliable power for AI. The expectation was that this transition would be smooth. The reality is that retrofitting a mining facility, which is essentially a hot warehouse with fans, into a Tier 3 data center for AI, which requires precise cooling, dust control, and redundancy, is an engineering nightmare. The delays in this transition are likely what caused the recent sell-off post-earnings. The market hates uncertainty, and construction timelines are the definition of uncertainty. I want you to take a moment and think about your own position here. Comment below how many shares of Bitfarms you currently hold and what your average buy price is. Are you underwater from the $4 highs, or did you get in at the sub-$2 lows? It is fascinating to see the distribution of holders in this stock because it tends to attract both die-hard believers and short-term flippers. Analyzing the charts further, we see a significant volume shelf around the $2.50 area. This acts as a psychological floor. Every time the stock dips near $2.50, buyers step in. This suggests that the market views the company's assets, the transformers, the land, the contracts, as being worth at least that much, regardless of Bitcoin's price. On the upside, there is heavy resistance at $3.50 and $4. These are the levels where people who bought the riot takeover hype are looking to get out at break-even. For the stock to clear these levels, we need a catalyst. That catalyst won't just be Bitcoin hitting $100,000. It will likely be the announcement of a specific signed contract with a major hyperscaler, like a Microsoft or Amazon, for their high-performance computing capacity. Until that press release hits the wire, the stock is stuck in show-me mode. Let's talk about the competitors because you cannot trade BITF in a vacuum. When you look at Fidelity ETFs that track this sector, you see Marathon Digital and CleanSpark alongside Bitfarms. Marathon is the 800-pound gorilla with a massive Bitcoin treasury. CleanSpark is the execution machine that hits its targets like clockwork. Bitfarms is the value play with a geopolitical twist. Their heavy exposure to Argentina and Paraguay was once a liability, now it is a hedge. While U.S. miners face grid congestion in Texas, Bitfarms has power stability in South America. But the market currently discounts South American assets due to political risk, trading them at a lower multiple than U.S. assets. This is why the Stronghold acquisition was so vital. It reweighted their portfolio toward the U.S. flag. If you are using Robinhood stock trading to compare these, you will see Bitfarms often has a lower PE or better price to book than its peers. But that discount exists for a reason: the execution risk of the turnaround plan. We also need to discuss the dilution word. It is the dirty secret of the mining industry. To fund the purchase of thousands of new T21 or S21 miners and to build these AI data centers, Bitfarms has historically issued shares, diluting existing holders. If you hold the stock in your Fidelity brokerage account, you might notice your percentage ownership shrinking even if the share price stays flat. This is the ATM, or at-the-market offering strategy. Management will argue it is necessary to grow. Shareholders argue it kills momentum. The reality sits in between. Without the dilution, they couldn't have bought Stronghold, but the constant supply of new shares acts as a lid on the stock price rallies. Every time the stock spikes on a Bitcoin pump, the company likely sells shares into that strength to raise cash, which knocks the price back down. This creates the range-bound behavior we are